Energy media readers, welcome to the interview today. We're going to be talking about oil field employment in Canada, and particularly in Alberta. And I'd like to welcome Carole Howe, who is the Vice President with PetroLMI, which is a division of Energy Safety Canada located in Calgary. So welcome to the interview, Carole.
Thank you for having me.
Now, when you and I interviewed you earlier in the year because PetroLMI had put out a forecast that 12,500 jobs would be lost in the Canadian oil field in 2019. Now, with the November numbers out, it looks like we're actually a little higher than that.
That's correct. When you include the November numbers, we're at a loss of about 14,100 jobs for the year for 2019. So a little bit higher than we anticipated.
And what do you attribute that to anything? Is there anything particular that's happened that's made that number a little larger than you had expected?
Well, I think that what we saw in November, we saw some additional layoffs in the pipeline sector. That was probably some of the biggest losses that we saw in November. And that's due in large part to some of the delays of the projects that we've been seeing over the last year or two. We did anticipate some of this work would start to move a little bit more quickly. Some of these projects might move a little bit more quickly when we looked at this forecast early in the year. So that's really the fundamental reason for the difference.
Are the pipeline jobs being lost due to projects like Keystone XL and Line 3, which is hung up in the regulatory process in Minnesota?
Yes, I mean, our expectation is that, you know, some of these projects staffed up, and we're anticipating that they could start to move ahead on activity, but that's been delayed. So they can only hold on to staff for so long before they have to lay some staff off until the projects sort of kick into gear again.
And what about Alberta? I mean, Alberta is has the most production, and the head offices are mostly in Calgary. There's a lot of oil field employment in Edmonton around manufacturing and services. And of course, we have a lot of employment out in the smaller communities like Devon and Wainwright and communities like that. Correct. So what effect are we seeing in Alberta? Is it bearing the brunt of these job losses?
It is. The vast majority of those job losses are in Alberta. And actually, I think I spoke incorrectly earlier. I mentioned 14,100. It's 14,600 jobs overall and 14,100 in Alberta. So you can see the vast majority of those jobs are in Alberta that were lost.
Now, PetroLMI breaks the employment down by three sectors. So we've got exploration and production, pipeline, and services support, I think is what you call it.
That's right.
And we're seeing a lot of the job loss in the exploration and production side. Is that primarily in the head offices in Calgary?
Well, certainly, as you've probably seen in the news in the last couple of months, there has been some head office layoffs. Husky is one, and there's other companies like Husky that have done some layoffs at the head offices, but some of them are also out in the field as well.
Now, you and I, when we talked a year or so ago, and we talked about the impact of digital technology like artificial intelligence, robotics, automation, on employment, and you said at that time that the oil companies were just beginning to implement this technology. Over the last couple of months, I've interviewed some other experts on that field, and they say that adoption is beginning to accelerate in the oil and gas companies. Are you, in your work, are you seeing that technology starting to affect employment numbers?
I can't say as we are seeing that directly. Anecdotally, that might be the case, but I think overall, companies are still moving in that direction. But in terms of actual sort of layoffs as a result of those technologies, I think it's still too soon to maybe make the link completely between those two. But certainly, you're right. Companies are certainly adopting these technologies quite quickly. I think seeing more an emphasis on reskilling people to try and adopt the current staff to these new technologies rather than actual layoffs as a result of them.
One of the points that was made by an expert, I think it was the fellow who runs one of the programs at NATE, is that the companies, even though they may be changing the nature of jobs in oilfield employment, and for his example was that instead of actually working on the rig floor, on a drilling rig floor, we might find employees sitting in a trailer monitoring the machines as they do the work. But they still need people with deep industry knowledge as they're being reskilled. Would you agree with that?
I would absolutely. I think the recognition that the industry requires both is really important. Certainly they're looking to people with technology backgrounds. If you come from the IT world, come into the industry, the lack of industry knowledge is key for people. It's really important that they have an understanding of both the industry, which is quite different. It's a very different world to be working in IT, as an example, in oil and gas versus an IT company or IT in another industry. So understanding how the world works in the world of oil is really, really important to a lot of these companies.
Now, we've seen in your numbers lately that the service sector is actually adding jobs. And now, are those jobs primarily out in the field?
Yes, I mean, in terms of some of the drilling activity, but that's not unusual at this time of year, because this is the time of year where activity picks up. So that's kind of expected to see some of that. But even last month, we did see a bit of a drop in the services sector. So while drilling, has improved a little bit because of the seasonality, we're still seeing a lower number of wells being drilled this year than we have in the past.
Now, in previous interviews, you've told me that a lot of the employment or the decline in employment is tied to capital expenditures, which had been, we'll call them restricted because of the pipeline capacity problems and companies having to cut back and curtail their production. And as we go forward, it's interesting to look at the investor presentations that companies make, because they're all showing a decline over the next 4 to 5 years of capital expenditures, yet they're also showing an increase in production, when I'm speaking mainly of the big companies. And is that a trend that you see throughout the industry?
Most definitely. We're seeing more production coming on without the additional capital spending going on. And a lot of that is because companies are fully utilizing the productivity they have currently and increasing productivity. So, I mean, we're seeing more production coming out of the oil sands without any additional capital required to go into the oil sands. So creating efficiencies, creating better productivity is really what they're doing, and doing it quite successfully. And in fact, it's getting noticed elsewhere. In the US, it's a lot of the investors in the US are starting to look at companies in the oil sands in Alberta and saying, the productivity levels of these companies and the success in growing production without capital expenditures has been impressive to them. So they're certainly recognizing that.
Is it a fair guess that those companies will be able to generate more production and increase their supply with the same number of employees, given the rise in labor productivity?
I mean, I can't speak number for number, but I think that's the expectation, is that the production is continuing to increase without adding additional staff. I mean, that's obviously good for the companies in terms of the efficiencies they're creating. Obviously, what that does mean is a lower employment numbers for the industry overall going forward, and that's what we've expected, that we're not going to see the hiring levels that we have in the past. Now, in the service sector, if drilling starts to pick up, that's where you will see the increase in activity and the increase in labor demand. But from a E&P perspective, they're probably going to certainly not ramp up like they would have in the past.
On the drilling side, I've noticed that the number of wells that get drilled every year goes down, but the length of the wells, the total kilometerage, I guess, seems to be going up. So it looks like they're drilling longer and longer laterals on these horizontal wells. And that would suggest that the drilling might actually stay stagnant or drop while employment remains the same in the drilling sector. Is that a fair observation?
Absolutely, that's correct. That's where they're getting these efficiencies from. They're able to get more product out of the ground by these longer laterals, definitely.
Now, the numbers as I add them up, if I recall correctly, Carole, is that we're Canada-wide, we're at about 172, 173 employees in the oil patch. And that's really about the level where employment bottomed out in 2015, 2016, is it not?
I'm not quite sure in terms of your numbers. Our numbers are that we have about 183,100 workers in the three subsectors we've talked about currently. And so that is a bit lower. Well, it is lower than when the things bottomed out, and it's kind of been over the last couple of years. It's gone up and down a little bit, but that's certainly much lower than when we you know, at the height of our activity in 2014, 2015. We don't expect those numbers to go back up to those levels anytime soon, if at all, ever. This at this stage, this is kind of the leveling out at this level. And then again, it's important to remember that these are just those three subsectors. If you start to look at job opportunities and labor demand beyond the three sectors we focus on, as you know, the workforce is much larger in terms of the indirect jobs that are created from our industry.
Right, that's a very good point. And I think that in the three sectors that you follow, it sounds like this really is kind of the new normal at that 183,000 level, and we may see it certainly not rise, but may even drop a little further. Is this a case where Albertans in particular have to maybe rearrange or rethink some of their assumptions about the industry around where employment is and the types of employment they'll be doing going forward?
Well, I think certainly the reality is it is a different industry. It's changing dramatically, and yes, you know, what this industry will look like in the next 5 to 10 years will be substantially different than it has been in the past. We're actually currently working on a 10-year outlook, labor outlook, that we will release in the spring. And what we're finding is that we are now really basing our assumptions going forward on what projects will move ahead, rather than the price of oil, which was a real driver for us before. The price of oil and gas, that created activity levels. The price of oil isn't as big a factor now as whether we can actually get some pipelines in the ground. So what you know, what people will be wanting to watch for is, are we going to get approval on some of these projects, including the additional LNG projects moving forward? Those will be the drivers of whether companies hire versus the price of oil or natural gas. At one time, if prices went up, you know, activity went up, and workers were in demand. Now it really will be driven by access to tidal waters, access to new markets. That will be the driver for new employment.
That's fascinating, Carole, and I think that that will represent a change in the way Albertans and Canadians, I guess, think about the industry. Any final thoughts on where employment is going to be going in 2020?
You know, again, I think our forecast in the spring will be helpful in that regard, but I think it's fair to say that we're not expecting any substantial increases in 2020 again until we start to see some activity happening, because some of these pipeline projects are moving forward. They've all been delayed, as you know, but we're optimistic that, you know, at least the Trans Mountain and others will start to move into you know, moving ahead now. If they do, then we'll start to see activity pick up to fill those pipelines, and we'll see employment happening, or additional employment happening. But right now, we expect that for 2020, that's probably going to be fairly subdued.
Carole, thank you very much for this. We'll look forward to interviewing you again.
You're welcome. Thank you very much. Thanks a lot.